terms of your strategy?
Well, I think we've been focused on several of the areas of the municipal market that performed strongly. Namely, we had a duration that was in excess of the benchmark for virtually the entire period, as well as an emphasis on longer maturities, about 20 years and longer that is. Also a focus on medium and lower investment grade issues and a selection of non-rated issues, as well as an emphasis on the revenue sectors that did well, namely healthcare and corporate-backed issues.
Some of those areas that did well in the past, are you continuing to hold the same amount of that debt, or do you see the portfolio shifting at all a bit this year?
Right now, in most cases, we are continuing to hold an emphasis in those areas. If you look back at the spreads in these various revenue sectors or mid to lower rating categories, the spreads versus high-grade municipal securities continue to be in excess of the long-term averages in most cases, and in none of the cases are we approaching the low spreads that generally occurred somewhere between 2005 and early 2007, so we think there's still room for continued performance.
You're pretty highly invested in California bonds. Given the recent upgrade, how are you thinking about California now?
Well, it is the largest state holding in the fund. However, we are underweighted relative to the benchmark, and we're in more revenue issues in the state as opposed to the state's general obligation bonds. That would be one area where we were underweighted, and if we had to do it over again, we'd probably add a little bit more weighting at the state level general obligation bond, because the spreads on those issues have come in faster than even some of the revenue issues that we own in California. Not considering any significant changes there right now, particularly given how strong the general obligation state bonds have performed. Seems like us maybe a time to hold steady with our allocation.
Another sector where you have some significant weighting, and I don't see this a lot when I look at some muni portfolios, is the weighting in education. Tell me what it is about education that you find interesting right now.
Well, we have a number of universities and other higher educational institutions. Particular emphasis in the charter school area. Can be a volatile sector. It does require a lot of additional research, but there is return available in the sector as a payoff. We are fortunate to have a bank of 24 research analysts in Chicago and Minneapolis that assist us in the selections generally for the portfolio, but we have arrived at an emphasis on the charter schools primarily through their work of finding exceptional values for us.
What are you seeing in terms of fund flows in the last couple of weeks, and what are your expectations for muni fund flows for the year? The environment does feel a little bit different than last year at this time.
It does seem a bit different. We experienced very strong flows across the firm, and in particular in the All-American Fund. At times it's a challenge to find values to invest in. The flows were quite strong in the summer and into the fall of last year. They have slowed a bit. I still think there's several $1 trillion of cash on the sidelines that has been coming in to equity funds as opposed to rotating out of bond funds, and because we are still seeing flows into the fund positive, just not as strong as we had last summer and fall.
What are your expectations in terms of returns for munis this year?
Well, once again, we had a very strong year in 2012 after not expecting quite the strength. I think that's occurred in 2009, 11, and 12. However, the closer interest rates get to zero, the less likely you're going to have these double-digit returns going forward. Given that, our best guess is that we'll see single-digit, mid-single-digit returns, perhaps the coupon plus a % or so. As you approach zero in interest rates, of course, mathematically it gets more difficult to continue to achieve the double-digit returns we've seen.